Saturday, October 15th, 2016, Monaco 64, home of alternative economics and contrarian views. So I worked for over 20 years in the financial sector in the city of London. And I was a broker, futures and options brokers for institutional clients. And the bulk of my business was in the bond market, government bond futures. So this is a subject that I'm familiar with, and I'll try to explain it to you, what's happening right now. I've made a few videos in the last few weeks, last month, even in July, about the bond market. You can look through my channel. There's an interesting one I made back in April, and I'll put it up on the card right now, and it says Fed-induced bond bubble will devastate financial system. And in it, I explain the mechanics of bonds. It's quite technical, but hopefully, it's clear to the layman out there. But later on in this video, I'm going to show it to you visually, really what's happening in the bond market, and I think it would be easier. But first of all, let's start out, and it's a subject I touched upon on Wednesday this week, the UK gilt market, which is the UK government bond market, and the fact that in the last couple of weeks, the yields have been rising very sharply. Like the 10-year yield, for example, on Wednesday, went up above 1%, which isn't much, I know, but the fact that a month before it was at 0.51%, so we doubled basically. So, and then Thursday, the market was a bit calmer, the bond gilts recovered a little bit, but yesterday, gilts had a pretty awful day. And early on, for example, the 10-year gilt went up to 1.15%. It did close at 1.1%. So the yield did come back down. But looking here, on the month, it's gone up 22 basis points. Sorry, 22 basis points on the month. And in the last 2 weeks, it's gone up 35 basis points. So we've basically gone from 0.75% 2 weeks ago. That's just when the drop from 130 in sterling started to where we're now around 121, 122. So we went from 0.75 to 1.1. And that doesn't seem much, but it is for a 10-year yield. So the 30-year gilt, today, Friday, yesterday, it traded up to 181.5. It got to a low 2 weeks ago of 1.486, and it closed at 1.76. So that's up 28 basis points in the last 2 weeks. And the 2-year gilt yield, it had a low of 0.1 this summer after Brexit, and now we're at 21.5 basis points, 0.215, and we close above 0.2, which in the last few months has been a key resistance. And today the high on it though was 0.277, and basically, it might sound good that yields are going up, but actually for bonds, it's the other way around. When yields go up, that's a bad sign. That means the prices are going down. And what a lot of people don't understand, and it's understandable, is that longer-term interest rates and even short-term interest rates, which the central banks set or fix, they are determined by buyers and sellers of bonds, lenders and borrowers. So the more people sell bonds, the higher the yield will go because the price goes down and the yields go up. So if there's more potential sellers of some kind of bond, that will drive the price lower and the yields will go up. So why is that important? I think it's because, as I said before, the bond market is the biggest financial market in the world. And in the US, you got the treasuries. In the UK, you got gilts. And these rates are used to determine the price of other assets because they're considered risk-free rate of return because the government, the government investors expect the government to pay you back no matter what happens, because they can print the money to pay you. They don't default. That's what happens in a fiat money system. So, and then there's an article yesterday. Well, I don't know if it came out yesterday or early today. Let's see, in the FT. I think it came out late yesterday, and it says UK gilt yields soar on hard Brexit and inflation fears. So the Brexit scapegoat again, and the subtitle is "Sell-off follows comments from Mark Carney, who's the governor of the Bank of England, that the Bank of England is willing to tolerate higher prices." So he said, the fact that the pound is being dumped, that yields are starting to move higher, doesn't matter. He'd rather, keep printing money to make sure we don't get deflation. And one of his excuses is that if he hadn't done what he's been doing since Brexit, that we'd have 500,000 people out of jobs. This is a guy who used to work for Goldman Sachs, so keep that in mind. Plus, I think he's originally from Canada, and I'm not having a go at him for being Canadian because I'm originally Brazilian and I live in the UK. But from what I read when he took over as governor is that he would stay here and then probably go back to Canada. He hasn't even bought his house. He's renting. So maybe he doesn't care, if he destroys the pound because you go back to Canada. We'll see. But the other thing that I wanted to talk about now is that there's a story on Bloomberg. It says, Yellen's talk of hot economy extends October long bond rout. So Bloomberg News is saying that Yellen is talking about the hot economy, but then you go into an article from Zero Hedge from yesterday, and it says U.S. economy to grow just 1.4% in 2016 after Atlanta Fed slashes third quarter GDP to 1.9%, half of its original estimate. So just to those of you who criticize Zero Hedge, they're not making this up. They're taking news from the Atlanta Fed. So if the economies don't growing, at 1.4%, well, forecast to grow 1.4% in 2016, how can that be an overheating economy? And if anything, the tendency is for that number to be revised down because the Atlanta Fed had an original estimate for Q3 of 3.8%, and it's now down to 1.9. So, they could very well in 2 weeks' time revise it even further down. So I don't get this Bloomberg reasoning that, long bonds are getting routed because Yellen is talking about a hot economy. What hot economy? And I've made videos about the Treasury market, that the fact that I think we've seen a bottom in prices, a bottom in yields in July of this year. And I'll put that up on the cards as well. We hit 1.35 beginning of July, the yield in the 10-year. This month, since the beginning of October, for example, well, let's go back to 27th of September, when we hit a post-July low of 155 in the 10-year yield. Yesterday, we closed at 180. It was up 5 basis points. So that's the highest yield in the 10-year that we've had, let's see here, since June. So in June, that was the last time we saw the 10-year yield at 180, and then we dropped all the way to like 135 the beginning of July, and now it's going, going up, which is a bad sign. The 30-year yield went up 8 basis points yesterday in the US, the Treasury, 255. So that's also the highest we've seen since June. It did hit a low of 210 basically in the beginning of July. So that's gone up, 45 basis points since the beginning of July. And if anything, all the data are showing the economy slowing down. So is it really because of a overheating economy? Or could it be that the bond market, is actually topped? And I've spoken about that as well, the 35-year bond bull market that started in 1981 when Paul Volcker let interest rates go up to 20% and he supposedly killed inflation. And we've had yields going down ever since. I could be wrong, we could still come back down in yields and break that July low. But right now it looks like that is the low for the moment. And I don't think it's because of an overheating economy. I think it's because the Fed, as I said in my video that is up on the card, has induced a bond bubble. And what does that mean? Well, it means that it said, oh, we're going to keep rates as low as possible. We're going to be doing QE. Our forward guidance is for rates to stay low. And that's driven bond speculators into the bond market. And what happens, even when yields go to near zero, they're still making money because the price is going up. And then, they go from the shorter term maturity bonds to the longer term maturity bonds because usually the yield on those are higher. So they get more for their money. And that's called duration. So that duration is the sensitivity of the price to the move in yields. And so we've seen speculators, investors, they've had to, search for this yield in the longer term duration, and it's driven the bond market into a huge bubble. And I'll show you now what I mean by, duration, convexity. So basically, the longer term and the lower yield the bond is, when speculators and investors buy it, the price rises a lot quicker. But at the same time, when they all trying to get out, the price is going to drop it's not going to drop arithmetically. It's going to drop how can I say, create a massive precipice. So the best thing to describe bond mechanics, in my opinion, is to show this picture here of the Matterhorn in Switzerland. It's a famous mountain, the Matterhorn. In French, I think it's called Cervin. But so if you think of the bond price, you start climbing the Matterhorn on the bottom left-hand side here, and it doesn't look very steep. If you fall there, you're not going to have any difficulties. But then you climbing up the mountain, and then you're going up, and it's getting steeper, and then you're getting near the peak, and if you fall there, you're in deep trouble. And so that's basically what the bond market has done. I think it's the central bankers basically created a Matterhorn in the bond market, and now all the climbers are trying to come down all at the same time, and it's really dangerous. As you can see, that is beautiful, the Matterhorn, but it's dangerous. So that's what I wanted to talk about. And how does that relate to everything else, to the stock market, to housing? Well, in the UK, mortgage rates are set by the 10-year interest rate. And I read an article last Wednesday, I think, in the Daily Mail that mortgage rates are already going, are higher, even though the Bank of England has cut rates. In the US, mortgage rates are set by the 10-year Treasury or the 30-year, depending on how long, a mortgage you have. And then stock market, The free rate of return is used to discount stock market prices. So the reason why the stock market has remained elevated is because of the low interest rates and low yields. If we see interest rates reverse, that could have an impact on it. And all the derivatives as well, OTC derivatives, a lot of the bulk of them are based on interest rates. So if interest rates move, and the reason I'm talking about that is that the article in the FT, they seem to like downplay, this move in yields, because they say, oh, we might go up to 1.5% in the 10-year yield, we're at 110 right now. But will we? Will we like actually go right through there? I don't know. We'll have to see. So yeah, just a little bit on the bond market. So if you enjoyed this video, please like, share, and subscribe. And if you like to donate to my channel, there's some links below in the description. Thanks for watching. Bye.